Did you know that even seasoned investors are making mistakes that could cost them millions? Warren Buffett, one of the greatest financial minds of all time, has pinpointed 10 common mistakes that nearly every investor makes. Mistakes that could be wrecking your portfolio without you even knowing it. Stick around because avoiding just one of these could change your financial future forever. Mistake number 1. Trying to time the market. Warren Buffett famously said, "The stock market is designed to transfer money from the active to the patient." And yet, many investors fall into the trap of trying to time the market. Take the case of Peter, an enthusiastic new investor who thought he could outsmart the market. He spent hours trying to predict every market dip and surge, pulling his money out at the first sign of trouble. But what Peter didn't know is that missing just a few days of strong market performance can cost you thousands over time. He sat on the sidelines when the market recovered, watching his potential profits slip away. Instead of predicting market movements, Buffett advises stay invested in quality companies for the long term. Because no one, not even the experts, can accurately predict short-term market movements. If you are enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. Mistake number 2. Not having a clear strategy. One of the biggest mistakes investors make is diving into the market without a clear strategy. Imagine traveling without a destination. You might get somewhere, but chances are it won't be where you want to be. The same applies to investing. Warren Buffett often points to this as a critical error, emphasizing the importance of sticking to a well-defined plan. Take the case of the investors during the dot-com bubble. Many jumped into tech stocks, riding the wave of excitement without understanding the fundamentals of the companies they were buying. When the bubble burst, they lost everything because they had no real strategy guiding their decisions. Buffett's advice is simple: know what you are investing in and why. Whether you're focused on value investing, dividends, or growth stocks, having a roadmap keeps you grounded during market turbulence. A strategy prevents panic-driven mistakes and ensures you are making calculated decisions rather than emotional ones. Mistake number 3. Ignoring company fundamentals. Warren Buffett is known for his love of companies with strong fundamentals, but many investors focus solely on the stock price without digging deeper. Case in point, during the dot-com bubble of the late 1990s, investors poured money into tech stocks without considering their actual business models. The result? The bubble burst, and millions were lost. Buffett, on the other hand, avoided the hype because the companies lacked solid fundamentals. He is that focused on businesses he understood, like Coca-Cola and American Express, which have stood the test of time. The lesson here? Don't just chase trends. Invest in companies that have proven track record and a sustainable competitive advantage. Mistake number 4. Over-diversification. Over-diversification, while intended to reduce risk, can actually dilute your returns. Warren Buffett famously says, diversification is protection against ignorance. It means that if you invest in too many companies, it becomes nearly impossible to keep track of them all, leading to subpar decision-making. A perfect example is investors during the dot-com boom. In an attempt to diversify, many spread their money across thousands of internet companies, believing they were mitigating risk. But when the bubble burst, almost all of those stocks collapsed together. Instead of reducing risk, their overly broad approach exposed them to mass losses. Buffett has always advocated for focused investing. He's known for putting big bets on a few companies he understands deeply, like Coca-Cola or Apple, where he's confident in their long-term growth. By concentrating your investments in high-quality businesses you truly know, you increase the likelihood of strong returns while managing risk more effectively. Mistake number 5. Following the crowd. Following the crowd is one of the most common mistakes investors make. and it can be disastrous. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This mindset helped him avoid the dot-com bubble in the late 1990s, when tech stocks were soaring and everyone seemed to be jumping on the bandwagon, while the masses were piling in. Buffett stuck to his principle of investing in businesses he understood. When the bubble burst, many lost everything, but Buffett's strategy paid off. A more recent example is the GameStop frenzy of 2021, where investors driven by social media hype rushed to buy stock, pushing its price to irrational levels. Those who joined late or didn't understand the fundamentals were left holding the bag when prices crashed. Following the crowd might feel safer, but as history shows, it can lead to costly mistakes. Mistake number 6. Emotional investing. Investing is as much about temperament as it is about skill. Emotional decisions often lead to disaster. When the market crashes, fear sets in, and many investors sell at the worst possible time. In contrast, when markets are soaring, greed takes over, leading to reckless decisions. Take the financial crisis of 2008. Investors who let fear dictate their actions sold off their portfolios at the bottom of the market, locking in losses. Buffett, however, saw it as a time of opportunity and bought stocks while others were panicking. His calm, unemotional approach turned the crisis into one of his greatest investment wins. The takeaway? Keep your emotions in check and stick to your long-term plan. Mistake number 7. Failing to reinvest dividends. Failing to reinvest dividends is a missed opportunity that can significantly hinder long-term wealth growth. Warren Buffett has always emphasized the power of compounding, and dividends play a crucial role in that process. Take Coca-Cola for instance, one of Buffett's long-term investments. When he first bought shares in the 1980s, Coca-Cola paid modest dividends, but by investing those dividends, his returns have multiplied year after year, turning an initial investment of $1.3 billion into over $25 billion today. Without reinvesting dividends, investors miss out on the snowball effect of compounding. It's like planting a tree and never allowing it to grow fully. Each dividend reinvested buys more shares, which then generate their own dividends, creating a self-sustaining cycle of growth for long-term investors. This strategy is essential to maximizing gains over time and capitalizing on the true power of compounding. Mistake number 8. Neglecting tax implications. Neglecting tax implications can quietly erode your investment gains. Imagine making a great return on a stock but losing a big chunk of it to taxes. This mistake is more common than you think. Take the case of early Bitcoin investors. Many saw their investments skyrocket but sold without considering the tax hit. Some owed huge amounts in capital gains taxes, which significantly reduced their profits. Warren Buffett understands this well and often emphasizes the importance of long-term investing, partly because of its tax benefits. When you hold a stock for over a year, you qualify for long-term capital gains rates, which are lower than short-term rates. Buffett's strategy is to let his investments grow for years, sometimes decades, minimizing the tax impacts along the way by holding onto assets and not selling prematurely. You allow compounding to work its magic while avoiding necessary tax penalties that eat into your wealth. Mistake number 9. Lack of patience. Lack of patience is one of the most costly mistakes an investor can make. Warren Buffett often says the stock market is a device for transferring money from the impatient to the patient. A real example of this is Amazon. In its early years, Amazon's stock was volatile and often doubted. Many investors who lacked patience sold their shares during dips, missing out on its meteoric rise. Those who held on saw Amazon evolve into a trillion-dollar company, transforming small investments into life-changing wealth. Buffett himself waited years for some of his biggest investments to pay off. Take his stake in American Express. He held on to it for decades, despite market swings. The secret? Patience. Investing isn't about quick wins, it's about staying the course and allowing time to work its magic. Successful investing rewards those who can wait, not those who react to every market fluctuation. Mistake number 10, investing in what you don't understand. Perhaps the most famous piece of advice from Warren Buffett is to never invest in something you don't understand. Buffett has famously stayed away from tech stocks for most of his career because he didn't understand the industry. Instead, he focused on industries he knew inside and out, like consumer goods and insurance. The key here is to stick with what you know. If you don't understand how a business makes money or why it's valuable, you're better off staying away. Buffett's success isn't about chasing the hottest new thing, it's about sticking to his circle of competence. If you like this type of content, then press the like button and subscribe to our channel.